Now let's look at doing a discounting using overnight index swaps. I have few credit issues relating to it and the involvement of funding costs and the role that is typically being played by funding value adjustment, credit value adjustment, and the debtors value adjustment, debit value adjustment. Now, just to understand, treasury rate historically before the crisis, what we see is treasury rates are a good reflection of the risk free rate, right? They are very lower than the other very low risk rates like LIBOR or swap rate. Compared to these are also treated very closer to risk-free kind of rates itself, and typically they are used very heavily in the valuation of the derivative securities also. The derivative dealers did not use the treasury rates for the valuation of the securities, but they were primarily using either a LIBOR or a swap. The reason being the treasury rates generally have a slightly lesser rate compared to the other low risk free rates that are typically available. And it's also like the treasury instruments to a large extent from a regulatory perspective, they need to be held by the financial institutions, which means they are not that heavily for a free trade. So there is a mandatory requirement that some amount needs to be held from a regulatory perspective. And the treasury investments require literally no capital. They have a favorable tax treatment. And because of all these things, why favorable tax treatment? State level tax is not applicable on them. Because of all these things, the treasury tax rates, treasury rates are slightly lower than a typical risk-free rate. So that's the reason by derivative dealers generally they never considered the treasury rate for doing a risk neutral kind of valuation. Rather, they did not use it as a proxy for the risk free rate. Rather, they were depending on the usage of LIBOR or swap rate. Until that time, it is fine. Until that extent, things are fine. Now, what we know theoretically is whenever I want to value a derivative security, we are going with a risk neutral valuation mechanism, which means all the expected future values of the cash flows, I am trying to discount them by a risk free rate of return. That is what is the risk free discount rate that we are typically talking of. And to a large extent, the LIBOR as well as the different treasury swap rates, they are used as proxies for various risk-free rates. Different derivative dealers, either they were depending on LIBOR or they were depending on the swap rate, because one, they have for different time periods, the LIBORs are available for different time periods, for different currencies. So for different maturities and different currencies, there are LIBORs that are available. Similarly, the swap rates are also available for this wider combination. That's the reason these have become more common kind of mechanisms for the risk-free rate. But what is observed is during the crisis, the banks, they were reluctant to lend each other because of the liquidity issues, and at the same time because of improving the need for improving the liquidity, they were holding more and more money in the form of liquid assets. Because of that, they were reluctant to do the lending interbank, which has resulted in the LIBOR actually going up drastically. And even the market practices have changed drastically after that crisis, and during the crisis as well as after the crisis. So here the differentiation has come. Even in terms of derivatives, they were starting to look at one, the collateralized transactions, the ones which are backed by very strong collateral, and non-collateralized transactions where the collateral is not posted. Now, instead of valuing all the derivative securities based on LIBOR or a swap rate, now the changing practice is all these collateralized transactions, they are trying to price using the overnight index swap discount rate, overnight index swap rate, using it as a discount rate, whereas for the non-collateralized, it is purely coming based on the funding cost that is associated to the bank. So if the funding cost is much higher, even that rate is typically being used, because earlier it used to be the case that the banks were quite comfortable in terms of borrowing or lending at the LIBOR itself. But now that is not happening. LIBOR itself is soaring up. Now it's no more a risk-free rate. That's the reason for non-collateralized transactions, they are typically valuing those kind of derivative transactions based on a rate which is reflecting the funding costs of the bank. Otherwise, if it is fully collateralized, it is being looked at from the perspective of overnight index swap. This is one clear differentiation that has come out post the crisis. Now, what is this overnight index swap rate? Now, the simple way to talk about is it's a fixed rate for a particular period in return for the geometric average of the overnight index rate. So it is like, okay, 1 day LIBOR, okay, overnight borrowing for 1 day, for 2 days, for 3 days, for 90 days. Overnight borrowings for each of the days. Take the geometric average for this, and this geometric average is what is called as overnight index swap rate. So where is that I can equate this to LIBOR? Borrow in the overnight market. So for 30 days or for 90 days, I am doing this borrowing day after the day. So every day I am doing the borrowing, I am rolling it on to the next day. So if I'm saying, if a bank is borrowing in the overnight market, it is borrowing for 1 day LIBOR. Similarly, it is rolling it over to the next day, next day, next day. So it is getting compounded over all the days, and during this period, it is entering into an OIS swap, overnight index swap. It is getting into a counterparty where it is typically exchanging this cash flow to an n-month overnight index swap rate, 90-day overnight index swap rate. And this fund, whatever has come, it is lent at LIBOR for an n-month period. So in this process, the overall thing that is getting created is the net exposure for this particular entity now is exactly LIBOR itself. See, first it is borrowing. It has borrowed some amount X in the overnight market, right? This X, it has lent at the rate of LIBOR. Right? It has borrowed, look at this, it has borrowed some X in the overnight market. That X, it has lent at the LIBOR rate for n-month period. So at the end of n-month, it is going to receive at a LIBOR amount as the interest rate. And in this process, it is whatever the loan it has taken in the overnight market, it has to pay by tomorrow. That is typically it is replacing it with a new loan that is being taken. So that is what we are calling as the rolling forward, which means this overnight loan also it is ending up paying at the end of n month period only. It is rolling it out from that particular period. And on the top of it, an OIS swap is what it is entering into. So whatever are there, it is exchanging them for the OIS swap, n month OIS swap. So now it is paying this OIS swap here, receiving LIBOR at the end of n months. So overall, the net exposure is same as the LIBOR for n months. But here, the problem for the bank is it is bearing the credit risk of the another bank. And that is the reason, in general, OIS will be lesser than the LIBOR itself. Though if the credit risk of the other bank does not exist, both of them are again the same. But because of that kind of additional risk that is being borne, we see that OIS will be less than LIBOR, and the difference is what we are calling as LIBOR OIS spread. In general, it is observed that that difference is 10 basis points. OIS is 10 basis points less than LIBOR. But during the crisis period of October 2008, we have observed that it has even gone up to the extent of 364 basis points as the difference. So OIS becomes much more cheaper compared to the LIBOR. As we discussed, LIBOR became very, very high during the crisis because no bank was willing to lend. Reluctance to lend has resulted in the increase of the LIBOR rate, which resulted in the spread peaking up to the extent of 364 basis points. Now, just like the way we create a swap curve, the zero rates derived through the process of bootstrapping from the most existing kind of treasury bonds, creating a swap rate curve for different maturity periods. The same logic we are doing even when I have to create an OIS zero curve. And the OIS zero curve is again very much risk required when we are going with discounting the cash flows using the overnight index swap value. So again, the bootstrapping, the same logic, just like the way we are doing it for the regular swap, we are doing it for the OIS swaps also. Based on the OIS rates, see, because based on the LIBOR, just like the way the LIBOR curve or a swap zero curve is constructed, even the OIS based on the OIS rates for different periods, they are getting bootstrapped and it is being created as the OIS swap curve. But the only difference is from the LIBOR per fixed kind of swaps. See, what could very well happen wherever the OIS swaps, generally they could be for very short maturities. But wherever they are not existing, make an assumption about the spread. After for 6 months, what is the spread? For 9 months, what is the spread? For 12 months, what is the spread? For 2 years, what is going to be the spread? Make some assumption about the spread between the OIS and the LIBOR, and first go with the prediction of the LIBORs for the different maturities and do the adjustment to typically come out with the OIS swap rate. So that becomes the OIS zero curve, and this zero curve will be used for the discounting purposes. And now if I have to do the valuation of the swap, typically the mechanism we use for valuation of the swap, if I am going with LIBOR per fixed kind of swap. So one party is paying LIBOR, the other party is paying fixed. And here we always value it under the assumption that whatever is the forward rate, LIBOR rates in the forward, whatever are coming out, they are going to be realized. That is the basic assumption in the valuation process for fixed to floating swaps. But here, depending the forward rate itself, now what is that we are doing in terms of, we are simply saying 1 plus r squared, 1 plus r2 whole squared is same as 1 plus r1 into 1 plus f12, right? Now here, if this is a 2-year rate, 2-year zero rate, and this is a 1-year zero rate, from here comes the forward rate. Now, if R1 and R2 are typically the swap zeros or LIBOR zeros, I get a different F12. And if R1 and R2 are the OIS zeros, I get a different F12. So the forward rate, whatever we are talking of, it depends on whether I am using the OIS or the LIBOR for the discounting purpose. Because this is the amount that is going to be paid, and this is what we are simply saying it would be realized. So, and that number could be different depending on whether the OIS is being used or LIBOR is being used. And for different periods, we are computing the forward separately from the corresponding swap codes. And if at all I require it for somewhere 4 months or 8 months kind of period, we are using the interpolation to typically arrive at the forward rates in a particular, for that particular period, which is intermediate to the regular time periods for which this rate is computed. And whenever we are looking at exchange traded ones, we don't incorporate anything else. It's a direct computation of the swap between the parties. But when I'm talking about a bilaterally clearing kind of a portfolio, so first of all, the valuation of the swap is simply done assuming that no party is going to default. As a default pre-entity, we try to compute the forwards for each of the periods depending on whether we are using the OIS or we are using the LIBOR or swap rate. Depending on that, we compute the forwards, and all those forwards we are discounting at the appropriate discounting rate. So initially we calculate the value with the assumption that neither side is going to default. But after that, once we have computed some value which is called as the no default value, now we are trying to consider what is the chance that my counterparty can default. My counterparty defaulting, so I'll do small adjustment to the value because the counterparty can default on the agreement. So I am reducing the value of that derivative by the extent the counterparty can default for me. Similarly, it very might be possible that I myself may default. So I will look at what is the chance that I will default, the firm will default on its obligation to its counterparty. So that is called as a debit value adjustment. The possibility that the counterparty will default to this particular firm is called as credit value adjustment. This firm will default to its counterparty is called as a debit value adjustment. That is going to increase the value as the risk is going to increase more. So the overall value of the derivative is going to be no default value minus the CVA plus the DVA. And it is clearly saying that credit value adjustment is respect to the counterparty and debit value adjustment is with respect to the firm, and this is clearly reflecting the collateral. Depending on what is the credit value adjustment, the counterparty may have to put up that much of collateral. What could be the typical debit value adjustment? I myself need to put up the collateral with the counterparty. So that's the reason we say credit value adjustment is whatever is the default probability of the counterparty multiplied by what is my loss? What is the present value of my loss given that my counterparty is going to default? And this calculation I do across all my counterparties. So the default probability of each of the counterparties, I multiply it with the present value of the loss that I am going to get if the ith counterparty is going to default, and I am going to add it over all my counterparties. The same logic we do for computing the debit value adjustment. What is the default probability of my firm towards a counterparty X, and what is the present value of the loss to this particular counter to each of the counterparties in case I default? I take the present value of all of them and add it over for all the counterparties to typically arrive at the debit value adjustment. And based on that, we find out the value of the derivatives in case they are going for a bilateral clearing. But here, all this is fine as long as the collateral is very much present, and this collateral is resulting in the adjustment with respect to CVA and DVA. But in case we are talking about non-collateralized kind of transactions, then it means the borrowing cannot happen at the risk-free rate. Borrowing cannot happen at the LIBOR. It is going to be much more costly. Then what is being said is the whatever the discounting that is being done, instead of discounting it at the OIS or discounting it at LIBOR, the entire thing needs to be discounted with the funding costs. And that is another adjustment that needs to be done, and that is what they started calling it as a funding value adjustment. And here the few things that cannot be justified theoretically. What discount rate should a company use for investment in a treasury bond? It should actually use a risk-free rate. But how can it use the funding rate from that perspective? And even a typical corporate finance mechanism says whatever the discount rate that we are using, it should reflect the project's risk only, the investment's risk only. It should not contain the funding costs. So if that's the case, how can I use the funding cost to value the derivative? So though in reality, lot of dealers are using the funding costs as a part of their valuation of the derivatives, theoretically there are so many limitations to the usage of such kind of concept. So a basic understanding of OIS and the credit issues, the adjustments to the derivatives values is something that we need to be comfortable with, right? All right.